Okay, so I gotta be a little bit careful with this one because I don't want to get in trouble. So to be clear, this is not investment advice. This is not specific financial advice to your specific situation. In fact, if you want specific financial advice about your specific financial situation, you have to talk to a specific advisor about your specifics. Okay, so a while ago I was talking to a client of mine and they were looking to get involved in their company's pension plan. Now, it wasn't really advice necessarily, they just wanted to bounce a couple of ideas off of me. And in the conversation I had with them, it came out that the person on the other end of this, I'm not sure if the other person was somebody who works in HR or just somebody who was answering email, but it was a company representative that was helping them on the other end. Anyway, one of the things that this person said is that if the client was a little uncomfortable with investing in the market, they could invest in something more conservative now, and then when the market rebounds, they could do something more aggressive with the investments. I adamantly disagree with that advice. It is of my opinion that somebody should always be invested accurately according to their risk capacity, risk tolerance, time frame, etc., like a bunch of metrics that kind of help determine how somebody should be invested. So if somebody is an aggressive investor, they should always be invested in an overall aggressive portfolio. If somebody is a conservative investor, they should always be invested in a conservative portfolio. Now, there are, of course, exceptions to those rules, but generally where we are in the market cycle isn't one of them. And it's especially not one of them for somebody who is just entering the market. And since this client was just starting in the pension plan, that's what they were doing. First of all, you have to understand that when somebody says the market balances out, what they're really saying is the prices in the market are going to go back to what they were before, the world started to melt, which means that everything that is down right now is going to be up again. So let's talk about what that means. Let's pretend for a second that you have a discussion with a specific financial advisor about your specifics. And when you talk about investments, the perfect investment for you, the one that ticks all the boxes that you are looking for, is Storm Shadow Funko Pops. Okay? Now, before the pandemic and the interest rate increases and the war in Ukraine, these guys were going for, let's say, $10. But right now, due to a bunch of issues, they're on sale for $5. Now, they're going to go up to $10 again. In fact, they're going to keep getting higher. You don't know when, but you know it's going to happen. Well, if you can get it for $5 now, why the hell would you wait until it's $10 again before you buy it? But if you wait for the market to rebound, that's what you're doing. Now, to be clear, I'm not saying you should be invested aggressively or conservatively. That's kind of a discussion you have to have with an advisor. And I'm definitely not saying that you should be invested in Storm Shadow Funko Pops. What I'm saying is that if you wait for the market to rebound, you're going to lose out on gains. And you should be careful with whose investment advice you take.